Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Risk assets selling off around the world as traders brace for reciprocal levies targeting all countries rather than the limited scope markets had come to expect. The U.S. president also threatening secondary tariffs on buyers of Russian oil if Vladimir Putin refuses a ceasefire with Ukraine, adding later that he didn't think the Russian president would, quote, go back on his word. And French courts due to deliver a ruling on whether National Rally leader Marine Le Pen can run in the 2027 presidential election comes after her trial over the alleged misuse of EU funds. Guy.
55.62, that is the key number you need to know this Monday morning. Kriti, the reason for that is the March low on E-mini futures. We're at 55.87. Take that out. Life's about to get really quite interesting if I can get that out. Euro Stoxx 50, we're down as well. So we're following this idea that Europe can disassociate itself with the US equity market. Seems to be coming under a little bit of pressure this morning. Where do you hide out? You hide out in the US 10-year. That's bid this morning. Gold is definitely bid. We'll talk about both of those two markets in just a moment. The countdown to the opening trade this Monday morning here in Europe starts right now.
You'd start with all countries, so let's see what happens. There are many countries involved. I haven't heard a rumor about 15 countries, 10 or 15.
So you're starting with all countries?
Well, essentially, all of the countries that we're talking about. Wouldn't be talking about all countries. It's not a cutoff.
Donald Trump causing a little bit of consternation in markets around the world. We've already indicated the fallout from those comments. It does seem, Kriti, as if he's taking a stronger line. The Wall Street Journal is going with the story this morning that Trump is pushing his officials to take a much more aggressive line with the US's trading partners. Europe waking up to that story this morning. Asia's already had to deal with it.
Well, we saw that this is exactly what the markets traded off of last week, this idea that you could have the sigh of relief, that maybe, just maybe, the optimism in Europe was that it wouldn't be as bad as expected. They would be targeted. It wouldn't be broad-based. So maybe not a massive hit to growth, but very specified. They were dreaming. That's not what's happening. And it's that volatility, again, that we were talking about last week that aches us back and forth about whether or not it's going to be the dirty 15, as he called it, the top 15 trading partners, or whether it's going to be the rest of the world. And we swung back to the rest of the world.
And equity markets don't like it. You're certainly seeing risk assets taking it on the chin this morning. You've got gold trading sharply higher. Treasuries are where you'd really want to be hanging out this morning as well. You're catching a bid. Going to see whether that feeds through into Europe. A couple of things stand out to me, though. One of which is that this idea that Europe can outperform is being stressed during this period. Equities are coming lower. Europe's had a great run so far this year. Does that come under pressure? If US equity markets go through their March lows, which is a really big line in the sand at the moment, you take those out, there's a big drop potentially behind it. What does Europe do in that kind of environment?
Well, the argument here is that, I mean, there's one argument, I should say, this isn't the consensus, but that the fiscal spend you're seeing out of Europe will somehow counteract or at least diminish perhaps the underlying hit to growth that you're going to see from these tariffs.
But isn't that already in the price?
That was literally what I was going to say. Is that something that people are already pricing in? And now it's just a matter of going to cash, de-risking completely, which is kind of what you're seeing today ahead of, and then maybe reevaluating down the line.
Let's talk about what happens as well in the energy markets, what happens in the broader commodity markets as well. You've got these two comments around Iran and Russia. Apparently Trump is very, very angry with Vladimir Putin. There's other language we could use, but we're not going to. You had the NBC interview first, in which that kind of language came to the fore. Then you had the comments on Air Force One, in which he appeared to kind of back down a little bit on putting secondary sanctions on Russian oil. So we're not quite sure where we are this morning as well. He also talked about Iran. And this is interesting, too, because he's put B-2s into theatre as well. So that's the Spirit bombers, primarily potentially there to talk about what's happening with the Houthis. They're there to target the Houthis. But Iran's on the list as well. And in the NBC interview, he talks about there will be bombing. I'm surprised the oil market is taking it as well as it is this morning.
I think it's, again, coming to the same realm that you're seeing in the equity market or even the bond market here, which is let's just wait and see what happens. Because Iran, and this is a real sea change from Donald Trump's approach to Iran. We know that he claims a lot of credit and is, of course, very proud of the fact that he was responsible for the assassination of the Iranian general and during his first Trump administration, something he's used on the campaign trail. So direct negotiations were not necessarily on the table. So for the Trump administration to even reach out for a conversation was already really a really big deal. Iran now saying absolutely not. We're not going to have those direct United States talks. And a lot of this does come back down to nuclear power. But to your point, the oil market not really blinking as much of an eye, even though this is the great unknown in the oil market. Not just what does the Trump administration do to Iran, but how does Iran respond? Crude's
at 73.58 this morning. There's commentary around that it could go back to 90, that it could go higher than that.
Yeah.
In a number of scenarios, not just one or two scenarios, a number of scenarios, you could see crude pushing sharply higher, which is what the Trump administration doesn't want. It wants lower oil prices. So all of this may be leaning against what the Trump administration is looking for economically, domestically in the US. So it's going to be interesting to see kind of how those two factors again interact. Do you see the economics having an impact on what Trump does? So far, that is not the case. You see that in the tariff landscape.
It's going to be fascinating. We're already seeing, I think, a realm of caution. I'm curious to see how people trade this going into tomorrow, because we're still waiting for Wednesday for the actual Liberation Day. We're still 24 hours away. So is this a de-risking? Then do you buy maybe the rumor, sell them? I don't know how you trade this week ultimately, but caution for sure early this morning. We talked about some of the politics right here in Europe, though, because, of course, a lot of eyes coming up in just, I believe, 2 hours' time when we're expected to hear from the French courts around Marine Le Pen. Now, this is a really big deal. She is trying to run in the 2027 presidential elections. In 2 hours, we might, emphasis on might, find out that she's not able to. This, of course, after a trial that's been going on for quite a bit on the alleged use of EU funds. We'll see how that turns out.
So this is about, the French press label this, fake European parliamentary assistance jobs. That's what the case is basically about. It's EU money being used domestically within the French political process when it shouldn't have been. That is what she's on the hook for, potentially here. She could face a 5-year ban, but that would be hugely political, wouldn't it? Some would argue, if you were to see the courts stepping into the political arena in that kind of way. So it's going to be interesting to see how the courts tread on this one. And there's all kinds of potential permutations. Would she be able to still be an MP? Would she be able to still stand or be part of a government if this case goes through and she is convicted? Even if somebody else became the next president under the RN banner. There's all kinds of interesting permutations around this. But I think French politics is about to be shaken if we do see a conviction here.
And return to the spotlight. I think you made that key point, is that if not her under the RN banner, then who, for example? Because the polling suggests that they are gaining seats, they are gaining popularity, and you see that across Europe, this rise of the far right. And Marine Le Pen got very close very recently, even in terms of the coalition parliament as well. Does she lose that momentum, or does it create some more domestic chaos if she isn't allowed to run? Do you see a more kind of civil response or protests or strikes or something like that?
We will wait, we will watch, we will bring you that news with a great deal of interest. Let's talk about what we've got coming up on the show. We've already indicated that equity markets look like they're going to be a little lower this morning. We'll talk about that. We're also going to be talking about how Europe responds to any potential Trump tariffs that come Wednesday. Zavh Meyers, Centre on Regulation in Europe, is going to be joining us, the research director there. Could Europe target US services? Could it target US big tech? There's a number of big cases coming up as well over the next few weeks, which could bring that area into the spotlight. We'll talk about that. Kristen, Citi Global Wealth at Work head, is going to be joining us to talk markets, as is Amy Gower, Morgan Stanley's head of metals and mining commodity strategy, is going to be joining us. That's going to be an interesting conversation, what's happening with gold, silver, copper. Kenton Jarvis is the new CEO over at EasyJet. That airline is opening a new base at Southend today, to the east of London. We will talk to him a little bit later on the show.
Fascinating conversations ahead. Let's talk about what we need to watch in terms of the data, in terms of the events for the entire week. It is going to be a roller coaster, that is for sure. Today, we're going to get Italian and German CPI. We've got French and Spanish CPI last week, so we'll see if the trend continues across Europe in terms of perhaps a little bit of a rebound, perhaps not as bad as expected. That was the theme from last week as well. Tuesday, Euro area CPI as a whole, and then some data over in the States is ISM manufacturing. But then I think we're all leading up to the back end of this week, which is Wednesday, Liberation Day, the Trump administration calls it. What do those tariff levies actually look like? When are they enforced? And where are there other kind of pieces to it? I think it also later is going to be a question of non-farm payrolls on Friday. It's a question of fiscal versus monetary yet again. So I would say my personal bet is it's a Wednesday versus Friday kind of week.
So you get through Wednesday, but then you've got to look forward to Friday. As you say, you've got to figure out exactly what that payroll number. At the moment, the whisper number, which has ticked higher over the last couple of days, stands at 90K. The survey number is 138. But I'm seeing quite a lot of variability within the economist call coming through on that number. What happens if you get a really terrible print? How much further forward could that bring the Fed? If you get a strongish number, does that push the Fed further out? Goldman Sachs is changing its call on what it thinks the Fed is going to deliver this year. 3 potential cuts coming through as the economy slows down. It's a lot riding on that number, I think.
The call out on Hantius. We'll see if that changes when Jay Powell speaks on Friday, because what's confusing here is what's more important, inflation or labor, the dual mandate, right? The full employment versus the inflation story. And on the inflation front, you get it from the tariffs picture on Wednesday. The full employment front, or lack thereof, on Friday. So I'm curious to see what Jay Powell says. Maybe that's the kind of main event of the week.
He will have some clarity, though, which will be fascinating to see how he reacts to that clarity on what the tariff narrative is going to look like. Still don't know what's going to happen on taxes. Anyway, what else do you need to know this Monday morning? There's plenty. A rocket built by the German startup ISA Aerospace flew for just 30 seconds over the weekend before crashing in what is the company's first attempt to reach orbit. However, ISA says the test in Norway met all expectations. Now, remember, European countries are seeking to reduce their dependence on the United States for launch systems that send satellites into orbit. This, of course, as defense ties with Washington come under some strain, let's put it that way. Rescuers in Myanmar are still working frantically to find survivors 3 days after the country's biggest earthquake in a century. The military government there says around 1,700 people were killed in Friday's massive quake, with more than double that number injured. And Chinese factory activity expanded again last month, with the official manufacturing PMI coming through at 50.5. While the number was above expectations, it probably came with a seasonal boost. It also, of course, comes ahead of fresh US tariffs, which are expected to be imposed on Wednesday. So this number picked up a little bit, didn't pick up by much. It is north of 50. They have some sort of manufacturing momentum. There's a lot of cases being brought against the Chinese at the moment at the WTO. I think it was nearly 200 last year, as countries around the world grow concerned about the export boom that China's trying to deliver. And that's what's boosting that manufacturing number. But this all, of course, comes ahead of the tariffs. And we've already had some. We're going to get more, it seems. China's going to be hit.
It is going to be hit, but I feel like we're having the same conversation with China that we're having to some extent with Europe, obviously on a larger scale, which is can the fiscal stimulus, can the fiscal impulse offset to some extent, maybe not the entire hit, but offset to some extent any sort of volatility or tariff uncertainty that may ultimately end up hitting China. That's kind of my question here, because you have seen this investor optimism in China resurge, I think.
But hasn't that been based on the idea that we are seeing a technology boom? That we are seeing things like DeepSeek coming through to the fore, and that is driving companies like Baba as well and you're seeing big gains in Chinese tech. Is that where the investor optimism is, or is it really around the macro story, which still looks very troubled at the moment? You've still got very weak consumer demand. You've still got a housing crisis, a building crisis that is still ongoing and yet to be resolved. So I wonder whether the technology boom that we're seeing there is giving us a false steer on how the rest of the economy is really performing.
Completely fair point. I see your point. I'm going to raise it with take a look at what copper prices are doing. So yes, the property sector is still quite concerning, but copper prices are still rallying, and seeing it as a kind of a bellwether for what China is doing. There seems to be some kind of broad-based optimism that's still sort of baked in there. Whether that's misplaced or not is a different story.
Is copper rallying because of US tariffs, or is copper rallying because of China?
Also a fair point,
Trump's talking about putting tariffs on copper, which is certainly already and has raised quite significantly copper prices in the United States, not maybe the rest of the world. So that's a factor. And we've started to roll over a little bit as well. And that's a conversation we're going to have with our commodities guest, I believe, in the second hour as well. Looking forward to that conversation. Coming up on the program, we're going to bring you your stocks to watch at the open, including Volvo Cars. The Swedish automaker has tapped longtime CEO Håkan Samuelsson to retake the helm as it looks to navigate through challenges, including that of U.S. tariffs. Plus, as we said, the commodities conversation, we have to talk about gold as well, starting the week at a fresh record, rising above $3,100. We'll discuss how the metals market is positioning ahead of Donald Trump's expected tariff barrage later this week. But up next, we're diving into these markets. We're going to be joined by Jamie Niven over at Candriam, the senior fund manager there. We're looking forward to that conversation. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus Bleeby TV Go is the function on your terminal. This is Bloomberg. Welcome back. Monday morning, 41 minutes to go until equities start trading here in Europe. You've got futures trading right now, cash trading in 41 minutes. It's an ugly morning for risk assets. Trump's tariff threats certainly hitting sentiment, and we're looking at the March lows again. Let's talk about that and how significant a moment that could be. Valerie's here with the details.
Yeah, it seems like the equity market is as nervous as I am about the week ahead. We are very close to taking a look at those March 13th lows, the year-to-date lows for the equity market. The S&P futures are less than 1% away from taking that level out. In just the last 4 sessions, Guy, the S&P 500 has slipped over 4% as we head into quite a big week on tariffs and on data. The risk-off sentiment, though, there is some things I want to point out that are a bit odd. If we flip on, we can just check cross-asset. Yes, equities are lower. We're having the traditional bid into Treasuries, but the dollar is not seeing any boost from this, Guy. And this is the 3rd session running that we have this traditional risk-off when it comes to stock and bonds, and not seeing a bid in the U.S. dollar. Is that the chat around the U.S. exceptionalism ending? People want to hide out in the euro, in the yen instead. The one thing that is flying off the shelf is gold, up more than 1% this morning, trading at record highs as we speak. This is the stagflation trade of du jour, shall we say. Gold really flying in the last few sessions on this stagflation trade. But I want to point out a few things when it comes to the Treasury market. We are seeing a belly-led rally, and to me, that is positioning for an economic slowdown. That's the market positioning for a recession. We have heard from some notes from the street of late. A few I want to mention. Morgan Stanley recommending their clients to be outright long the 7-year sector on a risk-off bid this week. We also heard from Goldman, who's amping up their calls when it comes to Fed cuts this year. They're now seeing 3 cuts from the Fed, positioning for the growth story from the U.S. to be damaged on the tariff narrative.
Great stuff, Valerie. Thank you very much indeed. So if I'm worried about risk assets, I'm not hiding out in the dollar. I am hiding out in Treasuries, and it looks like gold is certainly continuing to catch a bid. That starts our conversation with Jamie Niven, Senior Portfolio Manager at Candriam. Good morning.
Morning.
Does that kind of sound about right? If I'm worried about risk assets, where do I hide?
Yeah, it's interesting, the dollar point that was just noted. I think what's changed is the market's now starting to price downside in risk assets as a recession risk, and therefore front-end Treasuries rally and the rates differential means that the dollar suffers. I think also, as you noted, the US exceptionalism has kind of reversed slightly.
So what am I doing? I'm worried about my equity sort of portion of my portfolio. I can buy bonds. Which bonds am I buying? Valerie's talking about the kind of the middle of the curve. Is that the place to be in the United States? Is that where I want to be? Or do I want to be in Europe? Do I want to be elsewhere? Do I want to stay in credit? Give me the diversification trade that you're looking at right now.
Yeah, sure. Interesting you mentioned credit as well. That's not something we like. Obviously, the correlation with equities, with spreads there. We think that credit's very expensive, particularly in the US.
It's been expensive for a while.
High yield side of things. Yeah, absolutely. But in answer to your question, where do you hide? I think the front and the belly of the curve is exactly the right place to go. If we start to see the labour market turnover, which is, I think, a key point for the Federal Reserve, even if inflation is slightly higher, I think Powell has noted that they're willing to look through inflation and see it as somewhat transitory. We've heard that phrase before if we think back a couple of years. However, it seems like that's the way they're looking, and that's the way the market's trading. So with continued risk off and the threat of US recession, the front end and the belly of the US curve is a good place to hide.
It's still unclear to me, and Guy and I were talking about this just a few minutes ago, what is the driving factor for markets? Is it still the fiscal and the tariff impulse and the inflationary impact there, or is it still the employment? Because it feels like the markets kind of trade sideways until we get a big payrolls number. And it feels like for this week, for you, what's the bigger day, Wednesday or Friday?
I think in terms of Wednesday, that's important, obviously, because everything is trading off tariff headlines at this moment in time. I think we've had a lot of risk off into it. We've just noted the lows on equity markets. We've had a big bid on Treasuries. I think there's probably some risk of buy the rumour, sell the fact, as it were, and Wednesday they could see some relief. Into Friday, I think it's a big question for Treasuries because, and it's somewhat asymmetric in my view, because if we see a downside print on the payrolls number, then that gives the Treasury market more room to rally. Because as I mentioned, the Fed are currently willing to look through inflation, and if the labour market starts to fall, it gives them the rationale or the excuse to cut rates or have insurance cuts.
I'm looking at 419 on the 10-year. Give us a ceiling, give us a floor.
Oh, where's the... I mean, yields can fall below 4% quite easily, even this week, I think. And to the upside, I think the upside is capped at 450. I know I've given you a somewhat symmetric view, but I think the downside, there's more in the medium term. Because I think both from a rhetoric point of view, in terms of what the Fed has said, in terms of what Trump said, 450 is probably the ceiling, even if we get a bit of relief on the back of the tariffs announcements and we see a decent payrolls number. I don't think we sell off much more than that. I think on the downside, if we do see a weak payrolls number, we can see a big rally in the coming months.
What is the gravitational effect into Europe off that? You see Treasury yields going lower. What happens here in Europe on the back of that? Does Europe and the United States feel like a different place right now, or are they still quite heavily linked?
Look, the correlation's always high, right?
Yep.
But recently the correlation's been a bit lower for obvious reasons, given the fiscal announcements in Europe and the kind of reversal of the positivity in the US.
Yep.
I think there's still going to be some pull from Treasuries, if Treasuries rally, I think. Bunds will rally, for example. But there is somewhat of a different picture there. And I think what's interesting for the bond market is, yes, we're going to have some positive impacts from the fiscal announcements we've had. Our economists have something like 0.5% of GDP growth this year and a little bit more next year. But I think the big question is about the issuance possibility with European bonds. So having been...
When you say European bonds, do you mean German bonds?
Yeah,
or do you mean,
those are like two different things now.
The BTPs in the book market are starting to feel like different places again.
Look, I think it's all going to be correlated, and I think there's going to be expectations for other European governments to start to spend as well. I'm not sure that we're going to continue to see a tightening in peripheral spreads in that environment, if I'm honest with you. In actual fact, I think that we're pretty tight on, for example, the BTP Bund spread. But just on the Bund point, on the issuance point, on European bonds, we do think that people have been positive on Europe for a long, positive on European bonds, negative on European growth for a long time, and we could start to see long-term investors unwind some of that now that we've seen a bit of a rally.
So when will deficits start to matter again?
Deficits matter in the medium term. I mean, look at France, for example, over the past year. We've seen a widening in the OAT Bund spread because of the issues there on terms of issuance and
Sure, but that spread hasn't moved for like 3 months.
No, but when we were talking about it a few months ago. But look, deficits in the US, it's got that safe haven bid. We're seeing it today, right? So I don't think market's going to start to worry too much about deficits. Yeah. And if you listen to what Bessent said as well, I mean, he wants to control that deficit. So actually there's some net positive news, certainly on that side of the Atlantic.
The OAT market has calmed down a little bit. French politics has calmed down a little bit recently. Precisely. Today it might heat up again. How much of a hair trigger is that market on in terms of the politics?
Yeah. Look, I don't have any view on Le Pen or the court case, but in terms of OE2, we think the fiscal dynamics there are negative. We think that the spread, as you noted, hasn't moved in 3 months. It's actually tightened. We think there's room for that to widen, and we do think there's going to be some later information there that sees OAT widening at some point.
All right, well, we're going to see if that happens in less than 2 hours. Jamie Niven, Senior Portfolio Manager at Candriam, giving us a worldview through the bond market lens. Coming up, we're going to talk about one of the major things he's watching, which is, of course, Wednesday, Liberation Day, as the Trump administration calls it. They hit this week. They hit the EU this week. But how will the bloc respond, and what mechanisms will they use? That's the conversation coming up next with Zavh Meyers from the Center on Regulation in Europe. Stick with us. This is Bloomberg. Thirty minutes away from the start of the opening trade. Red across your screen. Euro Stoxx 50 futures down a whopping 1% and selling off as we speak. It's not alone. Take a look at the CAC 40. You are seeing some underperformance in France relative to the rest of the market, but the DAX, at least from a futures picture, right on its heel. So really seeing some pain when it comes to the equity market, really setting us up for a poor U.S. session as well. But as risk assets sell off, non-risk assets, safer assets, haven assets catch a bit of a bid. And you can see that right off the bat with the German 10-year, the French 10-year, even the Italian 10-year, of course, following the lead you're seeing over in the States.
Big week coming up, massive week coming up, number of big risk events. Obviously, the main one comes Wednesday. The European Union, as is the rest of the world, preparing for a massive round of US tariffs amongst its retaliatory options. And we're talking about the EU here. Are measures potentially to target American technology and services companies? these companies rely very much on the EU market, which is huge for them. Some in the bloc believe that the so-called anti-coercion instrument, its most powerful trade policy tool, should be on the table. So what should the policy response look like? Let's start that discussion now. Zavh Meyers, Director of Research at the Centre on Regulation in Europe, joining us around the table. Nice to see you. There has been some discussion that Europe should target US services, that this is the area of weakness that the European Union can get a response from the White House on. How big a risk would that be?
I think it would be quite risky. I can see why the EU wants to go down this path. So on goods, the EU has a trade surplus with the US, but the situation's in reverse when you look at services, where the EU imports about 109 billion more each year from the US than vice versa. And so, this is potentially quite a useful area for the EU to target. And of course, we know that the US president is quite close to tech CEOs, and so hitting companies like Apple, Meta, Google could be a potentially useful way to get attention. What the EU has focused on so far are kind of goods that don't have a huge impact on the European economy overall, things like Harley-Davidson motorcycles, Kentucky bourbon, for example, constituencies that are likely to be influential in Washington, but not make such a big difference on overall EU-US trade. And the EU is kind of running out of options for dealing. So
let's talk about the risk of doing this.
Yep.
A, presumably there is a risk that you get a big response out of the White House, and B, there is an economic cost, presumably here in Europe, that would be fairly significant as well.
Yeah, and there's a few factors to think about there. Obviously, there's this competitiveness crisis in Europe, this perception that productivity is very low, and what we need to do to solve that problem is to boost digitization across the economy. And for a lot of the digital services that Europe is going to rely on, US services are really the only game in town right now. And so raising the cost of them, making it more difficult for them to do business in Europe, you can see that there is a tension there between the two different goals of boosting competitiveness and protecting its existing economy that Europe has to face. So that's certainly, I think, one question that Europe will be considering quite closely. The other, of course, is that services is a kind of an untested area for trade wars, and so keeping the dispute to particular goods sectors might feel a lot more safer for a lot of EU member states.
You mentioned kind of this access to technology and innovation. We kind of saw that with Apple and their AI product, having it not released here, but released in the States and in other parts of the world as well. Is there any sense of a U-turn from kind of the European lens of a change on that policy? I mean,
there's certainly a degree to which the EU wants to simplify its laws. There's a perception that it's maybe gone too far, too fast. The last 10 years, I think there are about 116 tech laws. So, especially for smaller firms that are trying to grow in Europe and digitize, this is a lot to get your head around in a really short period of time. What I think Europe is insistent on is that most of these laws are protecting important European values, things like digital competition and making sure that you don't have one company monopolizing certain parts of the tech sector, and protecting online safety, for example. And on some of those issues, it seems like the EU is at loggerheads with the US, and there is really no appetite to walk back those basic principles.
Can you put a number on it, as in, and I'm putting you on the spot here, because one of the things Donald Trump has talked about, is, as we discussed, is these non-tariff barriers. And he's basically saying that any reciprocal tariffs will come in line with VAT and with EU regulation, and specifically EU tech regulation. There's been plenty of studies about just how much EU regulation costs American companies. But there are some varied numbers out there. Do you have a number on what that expense looks like?
I thought it would be an incredibly difficult number to calculate. What I do know that I think Trump will focus on are fines that are issued against US tech firms. And there are actually two coming down the pipeline this week, most likely. One against Meta and one against Apple. And if those numbers are very large, you can see Trump kind of fixating on them and seeing that the US has to retaliate in some way. But I have to emphasize, though, that these are EU laws. Companies around the world, including European companies, have to follow European law when they do business in Europe. This is not a barrier to trade. This is just the standard part of the way that regulation works.
You do wonder whether, though, Europe would like to maybe de-emphasize these right now. It just comes at a really difficult moment. So does politics start to interfere into these cases that are coming through? That will be if there's any hint that these cases aren't as aggressive, maybe there'll be a suggestion that politics is at play here.
Well, I'm having a little bit of deja vu because this was the exact conversation we had with the Microsoft Activision deal right here in the UK, where ultimately, I think it was at the time Rishi Sunak was saying we need to deregulate, we need to have these kind of M&A, and the CMA was digging their heels in. But let me bring that back to you here. When it comes to those fines, it's always been kind of thought of as a prick and not really the snake bite and very, very small fines relative to what it may be. Which direction is the EU likely to go in? To Guy's point, if the politics come in, increasing those fines or decreasing them?
I think this week we're likely to see lower fines, and that is, or at least on its face, it will not be because of Trump, obviously. Yeah. But I think it's because the law that is being used to impose these fines is the Digital Markets Act, which is a relatively new instrument. And lawmakers at the time said, this is all very straightforward. It's self-executing. The companies know exactly what they have to do. That is not the case. These are high-level principles. There's lots of different ways the tech firms can choose to implement them. And the Commission is really in a dialogue with the companies, or ought to be, about what exactly they need to do. Yeah. And so I think at this early stage of not, trying to clarify what the law means, imposing really high fines at the start isn't the way to go. I think it's much more sensible to set low fines, set the expectations for firms. And obviously, if they don't comply after that, will
there be a suggestion that politics, do you think, is at play here to a certain extent? Because right at this moment, as you've said, this is not the time you want to have a massive fine out there. Trump will potentially respond to that. That's going to complicate all kinds of other factors. Do you think there will be a suggestion that maybe there has been a sort of tap on the shoulder and maybe we go easy this time and we'll talk about this further down the road?
I think there'll be perceptions that is the case, but I think the Commission really has to and will be putting its head down, thinking about what are the facts on the ground, what is a fair fine to impose here. And I do think that going in hard with very high fines right now on this new law that's untested probably isn't the way to go. I mean, I would say as well, these are fairly technical rules, right, about how Apple has to allow app developers to allow customers to buy products outside the App ecosystem. It's fairly complicated. There were a set of rules that were imposed a few weeks ago on Apple, again under this same law, and it didn't seem to get much traction amongst the Trump administration because it was just kind of very difficult to understand. And that may again be the case here, but we're yet to see.
What do remedies in a conversation like that look like? What kind of shaping of behavior of businesses can happen?
Well, I think, as you mentioned, we saw really high fines in some past antitrust cases in the EU that, produced some headline-grabbing numbers, but didn't really change the market structure or the market dynamics. The same big firms that we saw in tech markets 5 or 6 years ago are still the same ones that are most dominant today. And so what we really want to see is not high fines because, as you say, they are kind of a pinprick for these large tech firms. We want to see changes in behaviour. And hopefully these new laws like the Digital Markets Act, which are very clear about the behaviour that's expected of companies, they can maybe do more to change the needle. But I have to say, the other part of that is if we want European tech firms, there's a lot of work that has to be done on expanding the single market, on simplifying regulation and making sure that the European
a common market would be nice and making it all work and fit seamlessly together. You're going to have a busy week, so we really appreciate you coming in and joining us first thing on a Monday morning.
Pleasure to be here.
Thank you very much indeed. Zavh Meyers, Research Director at the Centre on Regulation in Europe. What have we got coming up?
We've got a little bit more on the auto front. Aston Martin out with a new forecast for growth as it reviews the tariff impact as one of our stocks to watch. We're going to dive into the details next. Stick with us. This is Bloomberg.
Take a look at where we are. 17 minutes to go until cash trading in Europe. Futures look pretty negative. You're looking at the March 13th lows today. If we go through those and keep an eye on what's happening with E-minis at the moment, stateside, that's going to be a big moment for the equity market. All of this, of course, comes ahead of the big day on Wednesday. The market's feeling a little nervous this Monday morning about what could come.
Absolutely. Let's go to one of our other top stories that we're likely to get an answer or some sort of result of in the next couple of hours. Marine Le Pen, leader of France's National Rally Party, will find out today whether she is banned from running for president in 2027. An immediate ban sought by prosecutors is a very real risk for Le Pen if she and her party are found guilty of diverting millions of euros in EU funds to finance activities related to their domestic agenda. Now, Le Pen has denied the allegations. Let's get a little bit more on this. Bloomberg's Caroline Conan joins us from Paris. Caroline, just walk us through what today looks like from the judge's perspective and the consequences for Marine Le Pen.
We're going to get the verdict around 9 a.m. UK time, and there are several scenarios for the National Rally leader Marine Le Pen. Of course, she could be acquitted. She could also get some jail time that she could potentially serve with an electronic bracelet, as well as a fine of 300,000 euros. And then she could get, of course, a suspended sentence that she could appeal. But of course, the worst case scenario for her would be if the judges order a 5-year ban from running for office applicable immediately, meaning that she wouldn't be able to appeal and she would not be able to run in 2027, which is the next presidential election. Of course, that would be a real shock for the French public opinion. Marine Le Pen, as you can see during her trial in November 2024, said there was a witch hunt going on, interfering with the democratic process. Even at the time, the Interior Minister, Gérald Darmanin, said that Le Pen should be fought in the ballot box, not in court. Marine Le Pen is accused, along with 9 former members of the European Parliament, of embezzling as much as 4.5 million euros of European public funds, allegedly hiring fake assistants, parliamentary assistants, who were in fact working for her own party operations, the National Rally, back here in France, and not working at the European Parliament. Of course, this verdict is really highly expected here in France, given she's never been closer to possibly winning the next presidential elections.
Okay, so really interesting parallels with obviously what happened in the United States with Donald Trump. Talk to me about what the opinion polls are saying right now and whether or not actually her party is ready if she is convicted. Is there a plan B?
Yeah, that's a huge question. And of course, there was a very interesting poll over this weekend in the weekend newspaper Journal du Dimanche. You can see 37%. That's the score she could potentially get in the first round of presidential elections if this election was taking place today, either against former Prime Minister Edouard Philippe, who's already declared his candidacy, or against former Prime Minister Gabriel Attal, who is also a possible contender. There are lots of contenders out there, of course, and a lot could still change over the next 2 years, given Emmanuel Macron cannot run again. He's already done 2 mandates, so he cannot run in 2027. And clearly his successor is not exactly identified. Where you are very right, Guy, is there a plan B at the National Rally? That's very unclear. Of course, we heard the name Jordan Bardella. You know, he was the one leading the campaign during the European elections last year and during the snap elections last July, where the National Rally tripled its number of seats in the French parliament, and that was a historical score. But Jordan Bardella is still very green politically. He's 29 years old, and he's, of course, been cited many times as a potential prime minister, but never as a presidential candidate. And in fact, he's not even tested in this poll quite yet.
Caroline, fascinating French politics to watch out for. We will bring you that result as we get it out of the French court. Caroline will be standing by to update us. Let's talk about what else we're watching this morning. The dollar continues to be firmly in focus. You'd think it would be catching a bid right now. Maybe not, Kriti.
It's not. And in fact, it hasn't for a little bit, which is interesting given that we're really staring down the barrel of this tariff worry. Liberation Day coming on Wednesday, payrolls on Friday. And historically, when you've had to deal with tariffs out of the United States before in the first Trump administration, the playbook was very much buy America. Basically, if the U.S. sneezes, the rest of the world catches a cold. We've had plenty of guests on our show say the same thing. But the market is saying this time is different. Let me show you how this kind of hedge funds and leverage funds are positioned for this moment. And you can see that bullishness going into the dollar, specifically around Donald Trump's kind of election as well, has really come off of a cliff. Since the start of the year, you've seen that kind of extra positioning in favor of that dollar, those long dollar bets actually fade to the point, and you really have to zoom in here on this far right corner. You are officially going negative as of last week, which really tells you guys that there's this idea that the market, when it comes to the dollar, is no longer positioned for a bullish America, buy America scenario, or even a defensive bid to the dollar. It's kind of barely neutral at the moment.
It's amazing, isn't it? Normally, historically, we have seen the dollar performing in this kind of a world. The dollar smile, we often talk about the kind of the risk side of that dollar smile. Let's carry on the conversation and talk about where risk assets are this Monday morning. Clearly, there is fear in the market, in risk assets, in equities as a result of what could be coming Wednesday. We've seen the comments coming overnight from President Donald Trump. Simon White, Bloomberg Markets Live macro strategist, joining us to discuss. Simon, you've written in the past about how the equity market risk assets are in some ways sleepwalking into this tariff narrative, that we haven't fully priced the risk that exists out there. We're seeing some more risk being taken off the table this Monday morning. But how do you think markets are positioned going into Wednesday? Do they really reflect the risk that could be coming down the pike?
Well, I think it's very difficult for markets to price something that's inherently uncertain. And that's something that we've seen, all through the Trump presidency so far. So, anyone expecting any kind of final resolution on Wednesday, very unlikely we're going to get it. This looks like the beginning of negotiation. And, the reciprocal tariffs that are supposed to come in on Wednesday, nobody is quite clear exactly how they'll look, and whether, for instance, in the UK and other countries in Europe, whether VAT will be part of that. So I think there's obviously a lot of frantic kind of negotiations going behind closed doors, and the market is just very difficult for markets to price in something that's inherently uncertain. So I think obviously that there is some risk being taken off the table, which is, as you mentioned, and we're seeing that today. But it's extremely difficult for the market to try and price in something that colleague Ven Ram today called it a known unknown. So we know something's going to happen on Wednesday, but we just don't really know exactly how it's going to look.
So that's Wednesday, Simon. What about Friday? What about the payrolls number? What about comments from Jay Powell? Does the monetary take a backseat to the fiscal?
Yeah, I think that's certainly the case over most of the last few months, but I certainly think the market's more focused on growth right now. We had some slightly more higher than expected inflation data on Friday, but yields didn't really respond to that. They are certainly more focused on growth right now. So it sort of feels like that if the payrolls numbers disappoint on Friday, that could see an outsized reaction from the market. But you've also got I think very importantly, the PMI and ISM data. So we've already had the flash PMI for manufacturing, which slipped below 50 again. We'll get the ISM. We should get that this week, I think. And then the services one, which is most of the economy, 70% of the economy. That one is still quite strong. That's above 50. So these are probably the most important data points: payrolls, ISM, and PMI. But as I say, The market, regardless of the inflation, the slightly more hot inflation we're seeing right now, the market seems to be very much focused on growth.
Simon, just very briefly, Nikkei's in correction. We've seen a 10% drop now. How do European assets perform if we see a big downdraft in US equities? Can they diverge, really?
They can outperform on the way down, which still means they go down. And I sort of suspect that's maybe what we will see. You've really got the big difference here is you've got fiscal tightening, or the projection of fiscal tightening in the US, and you've got potential for fiscal expansion in Europe, and really capital would probably want to flow from the US to Europe. But that does not mean that Europe is immune from a fall in equity. They could fall, but they could outperform on the way down.
Absolutely, something we're going to be keeping a very close eye on. Simon White, Bloomberg Markets Live macro strategist. We thank you so much. You have more analysis from him and the team. MLIV Go is the function on your terminal. Let's get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we're going to be focusing on the sectors exposed to the tariff concerns this morning, given the commentary we've seen from Trump over the weekend around potentially tariffs coming on all countries. Take a look at some of the losses we've already seen over the past year on the auto stocks in particular. Stellantis already down 60%. The parts makers, Forvia, Continental, also going to be in focus as well. Also, the drink stocks, heavy losses there, given that sector also in the eye of the storm in terms of the tariffs. Keep an eye on Diageo, Remy, all the usual suspects on that one. And the metals and mining companies, given we are seeing declines once again in the base metals prices today. Iron ore down around 2% this morning. Keep an eye on that one. Then in UK retail, we've got a shock resignation over at Primark. The CEO standing down after 16 years at the helm. This is as the company says that the firm did find some behaviour in a recent event, so he has stood down. Also keep an eye on Aston Martin. Bit of a share sale there, raising around 50 million quid. Could be taken positively for Aston Martin this morning.
All right, Joe Easton, our equities reporter, walking us through some of the stocks that could be on the move in just about 5 minutes' time. I think from a macro perspective, it is still very much do the technicals trigger a broader sell-off or a buying moment?
So 55.62 is the low in March for US futures, for S&P futures. We're currently trading at 55.78. You get through that, maybe opens a trapdoor for the markets. In terms of where we are this morning, looks like we're going to be down circa 0.75 to 1%. On European equities. The open is next. It is time for this Monday's opening trade. This is Bloomberg. Monday morning, good morning. The setup for European equities, for US equities, looks pretty ugly. And let's just recap what we saw Friday as well, because we've added to the story from Friday, but Friday is still worth thinking about. This was the sell-off that we got. The white line here is Europe. The blue line is the United States. You get a sell-off in the States. That's what kind of drags us down. We then basically trade sideways as we come through into the end of the week, and we're thinking about what could happen over the weekend. And what happens over the weekend is that Donald Trump comes out with fresh comments around what these reciprocal tariffs are going to look like. It spooks market even further. You've got a down session in Asia. It looks like we're now going to see a down session in Europe. Quick look at futures just to give you an idea of what we are looking at right now. And remember, we're eyeing the March 13th lows in US equities today. That's going to be a big line in the sand. Euro Stoxx 50 futures down by 0.8. FTSE's down by 0.7. DAX futures down by 0.7. There's a lot going on this morning. French politics could be another story that we need to throw into the mix as well. But we'll get to that, Kriti, maybe a little bit later.
Absolutely. There's plenty to digest. We'll kick it off with where you started here in terms of the individual movers to keep an eye on with that tariff story. Already Aston Martin coming out and saying they are expecting those tariffs to weigh on sales volume. So we'll see how those comments are really affected and reflected in these markets. They're also looking to raise about £125 million by selling shares and talking about an F1 stake as well. So those are some of the headlines around Aston Martin. AB Foods as well, dealing with basically a scandal and a probe into a behavior over at Primark, one of the companies that they own. But Telecom Italia, I think, is the one that is catching my eye the most. This is coming after further M&A when it comes to a potential 15% stake by another Italian firm. We're going to see how that all shakes out at the open, Guy.
Absolutely. Talking of that open, it is almost upon us. It's time for the opening trade. So let's show you some numbers. As I say, we are expecting a negative story for European risk assets this morning. Let's take a look at the numbers that we're going to post first thing. The opening trade, FTSE's down. We'll see how much it continues to drop by. The IBEX is out early this morning. It's down by 0.7%. That is pretty much the benchmark number I think you're going to be looking at for a number of these indices this morning, down by 0.75 to maybe 1%. So maybe we're expecting further drops to come through for the FTSE 100 as it starts to open up. How does Europe perform in this kind of a market? Is it going to basically one-for-one mirror what we're seeing over in the United States? Is there going to be some divergence? I think that's a key question for PMs this morning as we watch what happens here in Europe. How much of a diversifier are European equities right now, and how much longer can this outperformance that we're seeing versus the US continue for? The CAC is down by 0.8%. We'll wait for the DAX in just a moment. Kriti, what is happening with the sectors? What's happening with the single stocks?
Well, the individual movers that are catching my eye are your sensational six, because if you right now are a heavyweight in Europe, you are selling off. I'll give you an example. ASML, LVMH, Schneider Electric, even Novo Nordisk, they are all taking a beating this morning in line with a pretty broad sell-off. 531 stocks in the red, only 52 in the green. And utilities are kind of the sole outperformer, high by 0.2% on a sectoral basis. But it does feel like it's a broad risk-off sentiment that isn't really kind of making any difference or any selection based on what kind of stock you're in.
Look at this. So up stocks in the Stock 600 this morning, 53. Down stocks in the Stock 600, 524. Everybody's on one side of the boat this morning in terms of what we are seeing. As you say, the heavyweights are where the damage is being done. ASML, ABB. I think ABB might be ex-dividend this morning. I need to double-check that one. Schneider's down. LVMH, Rolls is down pretty hard. Big outperformers. The tech space is in there. You've got some of the defence stocks as well under a little bit of pressure. There are not many stocks to the upside. 60 stocks this morning to the upside. 524 to the downside.
Yeah, it really speaks, again, you mentioned it, it's the broad-based nature of this all. But I'm also seeing, when you look at kind of the individual performers as well, and these, you're seeing it on the screen, the top 5 worst performers in the Stocks 50, you're starting to see it really spread the gambit. I mean, it's a lot of the tech names. You've got ASML and Schneider kind of fighting almost basically for the crown of which one's selling off the most. When you have Rio Tinto, you've got some banks in there and consistently moving. That is both a defensive sell-off and a cyclical sell-off from what I can see. Absolutely.
What you are seeing is the bond-sensitive areas of the market, though, maybe outperforming. Utilities are the only stock sector to be in positive territory this morning. Real estate is absolutely flat as a pancake. Telecoms doing relatively well. The kinds of areas you would normally expect to do better in an environment where yields are coming lower. And we're certainly seeing that with Treasuries this morning, and it's ripping through into the European bond market as well. So that's where you are seeing people maybe hiding out a little bit. You've got the grocery stocks doing well, the food and beverage, the healthcare stocks. This feels like a defensive setup this morning.
It absolutely does. And I'm saying we're I guess getting an opening trade on the DAX as well is now opened lower by about 0.9%. So again, the sell-off is broad-based, even though traditionally when we see a sell-off in Europe, that defense sector, as you kind of mentioned, in Germany tends to be the outperformer. Not today. Today is
sell everything.
Yeah,
it does appear to be sell everything.
Exactly. Get out of it. Well, let's see if that's the right approach and bring in a true expert here. Chris Bitterly, head of Citi Global Wealth at Work, joins us around the table. Welcome to the show. Welcome back to London. Lovely to have you.
Good morning.
Good morning. You picked a great day to join us in that everything is selling off. What is the market reacting to here?
At least it's sunny outside. So the weather is good, but the market clearly is a little bit gloomy. I would say, I mean, when you look at the price action that we're seeing, it's very similar to what we've seen within the U.S. market. Anytime that you have utilities, kind of defensive sectors, real estate, consumer staples as the winners of the day, that's something that we're seeing within the U.S. market. And I think the big question really is this outperformance of whether it's Europe, whether it's Asia versus the U.S., is that sustainable when so many of these companies, their revenues are generated in the U.S.? So on average, I think the numbers for the UK and Eurozone are around 25%. You take some companies like in Asia, like TSMC, and that's close to 75% of revenues. So yes, there is a trade in terms of being outside of the U.S., but Wednesday's a big day in terms of figuring out what it actually means for profitability of these companies.
So how does that work then? If we're talking about companies, and I can appreciate that we don't have the details yet, but if you're talking about companies that have that exposure to the U.S., as you mentioned, do you sell them? Do you buy them? I'm still unclear on what that trade is. Is it a defensive story or a that's more exposed, let's go domestic? How do you think about it?
We actually added exposure. We added international exposure into our portfolios in Q4 of last year. That was more of a story of concentration and diversification. So when you looked at the valuation disconnect between international equities and U.S. equities, when you looked at the fact that U.S. equities represent close to 65% of global market capitalization, but only 50% of the earnings, there is a reason for diversification. I think what the market has done, though, year to date, has really been significant flows out of the U.S. into European and Asian markets. And now the question is that just a trade or is this really a sign of a longer-term investment? And I think for now it's a trade.
Right. So what are you advising your clients to do, therefore? Is we gone too far? Does Europe do better if we continue to go down? Is it an outperformer, but only on a relative basis? What are you seeing?
I think having diversification is a good thing, period, in these markets. And it extends not just U.S. versus international, but also within having fixed income exposure within your portfolios. And so whether we
When's that going to work? When's that going to start working?
It has worked, actually. I would say having U.S. fixed income within your portfolios year to date, when you look at the reason our clients are not panicked is the fact that if you have fixed income exposure, if you have diversified equity exposure where you weren't significantly overweight the Mag 7, year to date, you're doing okay. You're not happy with your performance, but you're not seeing those big drawdowns, or you're not even experiencing anything close to a correction. So I think the major question here for those investors is, should I be adding exposure and buying the dip? And we are not. And so that's a hard thing to say. It is a hard thing to say. I know this 5,500 level within the S&P 500 is something that people are testing and watching. But I think that the challenge is you have three risks. You have policy, which policy uncertainty, as we all know, insanely high, profits. So going into Q1 earnings, what are we going to hear from these companies? What is their guidance going to be with all of this uncertainty?
Do you think we're going to get guidance?
You know what's scary? I think that's actually a scarier point, right? Like, if you, right now, someone guiding lower but having some degree of visibility, that's okay, right? That's just saying that we had lofty expectations and we're bringing them down. If companies start pulling guidance, that's a completely different story. And then the last piece, when you look at positioning, we have not seen capitulation. We have not, what did we get in the VIX? High 20s? And so when you look at those three things, policy, positioning, and then profits, the risk is not skewed in your favor.
Can I add another, or maybe two other P words there, which is kind of purchasing power? Yeah, purchasing power is going to be another one, because you're talking about margins and you're talking about kind of how much guidance can people give. But hasn't this been a story so much for a lot of American corporates, but I would argue European corporates as well, where any increase, supply chain increases or policy uncertainty, they can just pass it on to the consumer. What are you seeing from that level, from this bottom-up approach? How digestible are price hikes should they come down the pike?
And so I think it depends on the company, quite candidly. So when you look at certain companies have that pricing power, it's also going to be a function of how strong your balance sheet is and your free cash flow generation. And so certain companies are going to want to be able to withstand some of that pressure to still maintain market share. But this is a real concern. And I know Chair Powell talked about inflation being elevated. He used the transitory word again. And he's saying, look, a lot of the rise that we saw in PCE was really due to the fact that people were accelerating a lot of their purchasing, which may be temporary. It may be, but then you're going to be able to see this whether it's solely in goods or whether what would be concerning from an inflationary standpoint is if you see it flow through to shelter and services as well, which is a different story.
So if you're an American stock, an American company, we'll call it that, is liquidity your friend right now?
Yes. Liquidity is your friend. I think whether you're an investor, liquidity, making sure that you have the right positioning, talking about asset allocation, if we're not buying the dip, having some liquidity such that when you do see a real spike in volatility or opportunity to buy, I think is your friend. And I think if you are adding exposure to companies, so if you're someone who has been significantly overweight cash, because this is the reality, you have certain investors, asset allocators, they're fully invested, but a lot of investors have been sitting on the sidelines. And their question is, when do I buy into this and how should I think about opportunities? If you're going to buy the dip and you're going to take advantage of dollar cost averaging in any way, it has to be on these huge free cash flow generating companies that can withstand some of this policy uncertainty.
But what is my signal for this to get back in again? There's so much policy uncertainty right now. As you say, it's kind of sky high. And there hasn't been capitulation. What am I looking for to start redeploying capital? What's the signal that you guys are watching for to make that decision?
I would tell you a couple of things that it's not, maybe.
Yeah, okay. Let's start there.
Narrow it down.
Let's narrow it down. So April 2nd, I don't think we're getting much out of April 2nd.
Okay.
I actually think Friday is a more important day in terms of
Kriti's
employment.
point. Yeah.
What are we going to see on Wednesday? We're going to see maybe some more information, but the market's not positioning for it. Maybe some of the sell-off is trying to position for it, but I don't think just the magnitude of the information we're going to get and trying to parse through and what that means for positioning, I don't think that's going to be a big event. Friday is important because I do think looking at the backdrop, from an employment, so there's two things we're watching very closely. The employment backdrop in the U.S. market. Are you seeing an acceleration or deterioration there? This is going to be the first report that we get that's going to actually incorporate maybe some of those layoffs that we're seeing from the government.
Yep.
So that's something that we're watching. And then the other thing is all of this consumer confidence and the sentiment data, because that's something that can become a self-fulfilling prophecy. And you're seeing that if people are pulling back on spending and you're starting to see the cracks in some of that data, when we know consumer spending drives about 65%, 70% of GDP in the U.S., that's something that we're going to watch very, very closely.
But it's the upper end, and the upper end is tied to the stock market. So it becomes quite circular quite quickly.
That upper end, I think, drives, it's like the top 20% drive 40% of spending, and it's the top 10% of Americans own 90% of the stock market. So
there's a connection.
There's a connection, but I think the wealth effect, though, on one hand, you could almost make an argument that that part of the economy is immune to whether it's inflation, but actually seeing a deterioration in the labor market, which we haven't really seen, I think that's something that would be a signal that we are running into maybe not a contraction, but certainly a real slowdown in growth.
And we'll leave it on that. Chris, nice to see you.
And it's sunny outside.
and it's sunny outside. We'll take the good news there. Chris Bidley will definitely take the good news here in London when it's sunny. Chris Bidley, thank you very much indeed for joining us. Head of Citi Global Wealth at Work. Thank you very much. OK, let's talk about what is happening in this market right now. As Kriti was mentioning just a moment ago, centre of gravity here in Europe is certainly feeling like a dark place this morning. As you can see, big stocks across the continent are under significant pressure. Even Nestle, these are the kind of safe. That's the kind of the safe side of the core six, is down by 0.8%. The Western family over at ABF having a tough morning as well. Joe Easton's here with the details.
So they are indeed having a tough morning, Guy. This as the stock falling around 4% in London now. The CEO of Primark, Paul Marchant, standing down following a probe into his behaviour at a social event towards a female employee, according to a statement. He has apologised and admitted that he made the wrong move there. But that is a surprise for the stock, and it is selling off this morning, a pretty big decline for the owner of Primark, AB Foods, dropping 4.5% at the moment, a decent drop in that one. And another big drop, Pets at Home here in London, the company warning of subdued markets, people not buying enough goodies for their cats and dogs, apparently, because that stock is getting hit pretty hard this morning. We're down almost 13% for Pets at Home today on a bit of a downbeat warning. Also talking about the rise in national insurance hitting their cost, a double hit for that one. Then in terms of Aston Martin, getting a boost, raising around 125 million quid, partly via selling more shares to Lawrence Stroll, the Canadian billionaire, but also looking to offload the minority stake in Aston Martin Formula One, of course, with Alonso, the driver over in Spain. He's their big star on that one, if I remember rightly. But that one getting a boost, given the renewed funding for Aston Martin AML. Decent move for that one, up 5% this morning. Then in terms of banking, we've got news, ING getting into the mix in terms of the Italian banking M&A. Banca Sondrio previously had a bid from another Italian lender, and now we're getting a bid, potentially a rival bid, coming in from ING. But it is around 5 billion euros worth of cash potentially they're going to be spending on that one. So we're seeing ING dropping very slightly here in Europe today. Then in terms of software, a big move in terms of M&A. Fort Knox, this is a company listed over in Sweden, getting a takeover bid at a massive premium. It's around a 35% premium, so we're pretty much coming up to that level today. This coming in from EQT, a consortium led by EQT. Fort Knox does software for HR, accountancy, that kind of thing. It's getting a big move on that one today. Then finally, just wanted to end on the electrification stocks, because really interesting, this sector, of course, all exposed to data centres, and that has had a really torrid run recently, including a drop on Friday. And we're starting the week once again on the back foot. Schneider Electric, ABB, Prysmian, Siemens Energy, all of them lower, given continued concern around data centres, probably a bit of a tariff play as well. But I thought that was an interesting note. All of those stocks starting the week in the red for the data centre stocks here in Europe this morning.
All right, Joe Easton from our equities team, we thank you so much walking us through some of those early movers. Coming up, we are going to watch our what's going on over in France. Marine Le Pen will shortly find out if she is banned from running for president in 2027. We're going to have the latest for you next. Stick with us. This is Bloomberg.
Welcome back. Monday morning, 18 minutes, 19 minutes into the session. Let's take a look at some numbers. Doesn't look particularly good out there this morning. Friday wasn't a particularly good session. Monday morning for risk assets, not a particularly good session. Let's just take a quick look at the breadth because we were bringing this one to you a little bit earlier on. And we now have 560 stocks lower in the stock 600. 35 are up, 7 are unchanged, and 559 are down. The breadth is not good this morning.
You paint a grim picture. How in character? Let me bring some optimism to the market story here. With one trading session left in the quarter, U.S. bank stock, one trading session into the quarter, U.S. bank stocks are on track to end their worst 3 months since the 2023 regional banking crisis. It's a very different picture for their European counterparts. Here comes the optimism. They're ending their best quarter since 2020. Here's to talk about this transatlantic divergence is Bloomberg's Charlie Wells. All right, Bloomberg's Charlie Wells.
That's his official title.
Yes, now we're making that. It's like your first name, Charlie Wells, is your middle and last. Walk us through the split. Why the divergence?
Yeah, I mean, look, let's start with the good news, which is that European banking story. And I mean, the macro setting is kind of different than what it's been really in the past 20 years. And I think you've got to think about that German cash bazooka, right? You've got the spending on defense. You've also got the spending on infrastructure. And that is boosting banks like Deutsche Bank, of course. But it's also kind of a rising tide lifting all banks, as they say in the industry, I would assume, where you might have a little bit of inflation. This means that even though the ECB has been on this path downward with rates, they actually may be a little bit concerned about going too far, and that actually benefits bank lending, of course. So they could kind of hit that sweet spot, and you've really seen that momentum upward in Europe. Look across the ocean, and you see this kind of like, I guess it's like a upside down S, where we had this huge boost of enthusiasm after Trump. Those ideas about deregulation, ideas about an increase in M&A activity, even a little bit of excitement there in the beginning of the year, and then that shift, that sharp shift downward as this kind of trade uncertainty set in. And what do we know about M&A? We know that in M&A, you want a certain environment, and that is not what U.S. bank stocks are getting right now.
Year to date, European banks up 21.42%, by far and away the best performer. As you say, not the story over in the States, but be a bit more nuanced. Talk to me about big banks, small banks. Where is the pain really being felt?
So we got a little bit of a canary in the coal mine last week with Jefferies, and that is not looking good, right? So they always report early, and what we saw is that M&A activity not great, that investment banking activity not great, and capital markets business.
We were meant to have a great year for M&A.
We were supposed to have a great year.
It was going to be fantastic.
And
not so
look,
much.
We have finally got to a point where the M&A numbers are just a tad higher at this point than they were last year. But if you dig under there, you see that some of these big deals announced late in this quarter, Google, acquiring Wiz, for instance, have been kind of jacking that number up, kind of giving us a little bit of a false read.
So it's fascinating that the M&A story is coming at the same time as the buyback story, which usually happens in opposite times, in opposite directions. So I think the message, at least for me, has been the banks are flush with cash. What changes this? What flips this dynamic?
I mean, look, so you had Mike Mayo last week getting this really interesting point where, short term, he's a little bit, concerned about what the earnings picture could look like in about 2 weeks. Long term, still thinking in the U.S. there will be that super cycle, that banking super cycle that comes when that Trump administration finally gets to that deregulation push. On the Europe side, I mean, we've had so much talk about the spending. Now we've got to shift into execution. What does that actually look like? And then also we've got this trade picture in the background. And we have officials here in Europe just saying, trade is not just a U.S. issue, it's a global picture. So does that bring a little bit of negativity to this continent?
Bloomberg's Charlie Wells. Thank you very much indeed. OK, let's talk a little bit about what is happening in Paris right now. We need to take you to the Paris courthouse and take you into French politics, because this is a huge moment. The next couple of hours, huge moments for French politics. Marine Le Pen, leader of France's National Rally Party, is about to find out whether she'll be banned from running for president in 2027. An immediate ban, which is, remember, being sought by prosecutors, is a very real risk for Le Pen and her party if she is found guilty of basically diverting millions of euros in EU funds, which were meant to be for employing EU researchers, EU officials for the party, but only EU facing, not domestic facing, and that is where this embezzlement charge comes into focus. Le Pen has denied the allegations, but we need to get details on what could happen next. The perfect person to talk to, of course, is Kenton. She joins us from Paris. Caroline, just the magnitude of what is about to happen, how important is this for French politics? How big a bombshell will it be if Le Pen is banned?
It would be clearly a bombshell, given she's never been closer to winning the next presidential elections in 2027. There are several scenarios expected at the Paris court over the next hour or so. One is, of course, she's found not guilty. That's unlikely. Another scenario is that she gets a suspended sentence, not applicable immediately, possibly some jail term that she could serve under an electronic bracelet or under house arrest. But, of course, the worst-case scenario for her that was requested by the prosecutor back in November 2024 during her trial is that she could face an immediate ban from running for office, meaning she would not be able to compete in the next presidential elections in 2027, where, as you know, Macron will not be able to run because he's already done 2 mandates. So, as you were mentioning, she's been accused of allegedly embezzling as much as 4.5 million euros of EU public funds between 2009 and 2017, along with 9 other former members of the EU Parliament, part of the National Rally. At the time of the prosecutor's request in November 2024, she said this was a witch hunt interfering with the democratic process. And over the weekend, she actually said that she was not nervous about the verdict because she could not imagine, she could not believe that the judges would sign today her political death.
Caroline, we've got about a minute, and as you were speaking, of course, we have live pictures of that Parisian courthouse as well. Walk us through the backup plan here for the RN. What happens if she becomes ineligible?
Well, she's been very high in opinion polls, 37%. This is the latest poll we have from this weekend. If she had to face, for example, the former Prime Minister, Edouard Philippe. Obviously, the plan B will have to see the National Rally president, Jordan Bardella, is an option. He's only 29 years old, though, and he's doesn't have much experience yet. Politically, he's been cited many times as her possible prime minister, never tested yet in any opinion poll as a presidential candidate. So, of course, there is a lot of question whether also she would use this, possibly the National Rally would use this to play the victim. I was reading earlier, we could see a sort of Trumpification of the French politics, just like we saw with Donald Trump after the Capitol riots.
Absolutely. Bloomberg's Caroline Conan joining us from Paris to walk us through the political story there. We thank you so much. Guy.
Coming up, we're going to talk golds. Continues to move higher. How long does it last? Maybe this week continues that trend or turns it around. We're about to find out. We'll talk about it next. This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session, seeing red on the screen, although perhaps bouncing off the lows we saw just about 15 minutes ago. You are seeing pain, however, across the equity session. A lot of this, Guy, has to do with just the volatility coming out of Washington, D.C. right now.
It was a crazy weekend. There was a lot happening. There was a lot of commentary.
Ahead of a crazy week.
On a lot of things. Yeah, I'm trying to get your head around the NBC interview and then the comments on Air Force One. And anyway, I suspect, as you say, we're just warming up for a busy week. So President Trump over the weekend threatening, quote, secondary tariffs on buyers of Russian oil if Vladimir Putin refuses a ceasefire with Ukraine. However, that was the NBC story. Then we get Trump talking to reporters on Air Force One, slightly toning the comments down. Take a listen to what he had to say.
You're talking about Putin. I don't think he's going to go back on his word. I've known him for a long time. We've always gotten along well. He considers Zelensky not credible. He's supposed to be making a deal with him, whether you like him or you don't like him. So I wasn't happy with that. But I think he's going to be good. And I certainly wouldn't want to put secondary tariffs on Russia, but if they were put on, it would not be very good for them.
The president toning down earlier comments. So in the NBC interview, he said, quote, he is very, very angry with Putin. He used other language, but we'll just go with very, very angry this morning. And he threatened secondary sanctions. What kind of impact would that have on the oil market? Do we believe what is happening here? Bloomberg's senior executive for energy and commodities, Will Kennedy, joining us around the table this morning. Not much reaction in oil this morning. But how would secondary sanctions work? Presumably India and China would be the most exposed here. It's just so hard to get your head around all of this. Yeah. Walk us through the process.
Well, it's hard to say exactly. This idea of secondary tariffs is a new one that exists in the president's mind. He's mentioned it before with Venezuela. There seems to be some... are these sanctions? Are they tariffs? Are they a combination of the two?
I probably should have said tariffs, but
if you take... Well, I mean, it's hard to work it out exactly, but if you take it at face value, it would mean that anyone who buys Russian oil would be facing tariffs of 25%. And, of course, that firmly puts, I think, most importantly, India in the firing line, which, since the war in Ukraine and Europe stopping buying most Russian oil, has become the number one buyer of Russian oil. And that does tend to take US sanction and trade policy very seriously. So it would, if it happened, and I think that's a very big if it happened, would pose big difficulties for India, which is very reliant on Russian oil to power its economy.
Can you just explain to our international audience, and more importantly me, what a secondary sanction actually means?
Well, I think we've never seen this proposal in detail and how it would work, but if you take it on face value, is that anyone who buys that oil then would face sanctions from the US, tariffs rather, as punishment for having done something that the US had asked them not to do.
So about Iran, because that was the other thing that came into play this weekend as well.
Look, I think Iran is a very live issue for the oil market. Clearly, the Trump administration has been quite clear all along that it wants to put more pressure on Iran to forestall its building a nuclear weapon. Trump has said on several times, I'd like to do a deal, but if not, we will come down hard. So I think the oil market is still very alive to the prospect of more pressure. And you've seen sanctions gently ramped up on Iran in recent weeks, more pressure on Iran and some bearing down on their oil exports, which had rebounded strongly in the latter part of the Biden administration. So I do think that is an issue. Whether that it's tariffs, sanctions, whatever, we do expect more pressure on Iranian oil exports from the Trump administration.
All right. Well, Kennedy, Bloomberg senior executive editor for energy and commodities, walking us through the oil story and, of course, where Russia and Iran play a role in that. Let's stick with the commodity space because there are several others that are on the move. We'll kick it off with gold here, starting the week with a fresh record high. I'm looking at over 3,100 on the precious metal. This comes ahead of those expected tariffs from the United States later this week. Does it sustain, though? Let's ask a metals and mining commodity strategist over at Morgan Stanley. Amy Gower joins the program. Amy, this move, we've been talking a lot about whether or not gold is ultimately just a defensive haven hedge, or whether there is a valuation, a kind of get in at the right time element to it. Where do you stand on that?
Yeah, I think, look, this move higher in gold has been building for quite a long time, and actually many of the points at which the market and many analysts have thought it's peaked, it's been able to carry on rising. And I think that's because there's sort of two different stories driving gold here. So one is the physical demand. That really started to shift in 2022 when we saw central banks buying a lot more gold. They doubled their rate of purchasing from the previous decade, and that has sustained. And then more recently as well, investor demand for physical bar and coin, and even ETFs starting to step in the last few months. So that's actually new inflows to gold coming through here, and arguably plenty more to go here. And then there's also the macro angle to gold of, how does it compete in an investor's portfolio against rates and equities and bonds? And that should be arguably getting better from here. We've had, tough macro backdrop for gold with this high interest rate environment. So as these come down, actually that arguably should be a tailwind for gold. So as long as the physical can hold and then the macro factors come through, we would say gold hasn't peaked yet.
Dive us a little deeper into the interest rate dynamic there, because you mentioned it. If the interest rate expectations come down, then therefore gold rises. But the Fed isn't exactly leading in that direction. The ECB is. Other parts of the world are. The UK, maybe. The BOJ, certainly not. And the Fed is really on pause. So that expectation that would be a tailwind to gold, hasn't that just kind of bottomed out?
Yeah, so I guess you could say the rates are still quite elevated relative to where they were before this rate hiking cycle. So it's really about the direction of travel here. Have we peaked, and are we generally moving lower? And that does make gold relatively more competitive. As you say, it may be slightly on pause this year, and that's where that physical demand story remains important. So we do also need to see that holding up. And those ETFs have just started to see inflows, the gold holding ETFs. And so we would look to that sustaining to believe that this rally continues to have legs.
How self-limiting could this be at the kind of price point that you think gold will peak at, so sort of 3,300? If we get there, what happens? What is it that limits the rally from there?
Yeah, so our bull case on gold goes to sort of $3,300, $3,400 an ounce this year. I think, whenever a commodity price rises, we do start to worry about demand destruction, particularly when something's moving very, very quickly. For example, jewelry, that's around double the size of what central banks are buying each year. Yeah. And often when you go to buy jewelry, you go with a budget. You don't go with an amount of gold you necessarily want to buy. So you do naturally get that effect coming through. You get more recycling supply as well. And even central banks, we've seen the Reserve Bank of India pausing in both December and February. So sometimes we might need to see a bit of stabilization, I think, for that flow to continue. What
happens in other markets around, the markets that orbit around the gold market, silver, platinum, palladium, all these other markets? What is happening there? Are we seeing the same effect? Silver has an industrial use as well. Is it more complicated when I get away from gold? Is gold the easiest kind of pure play in this story, or are there others that I can work around as well?
Yeah, so largely the central banks aren't buying the other precious metals, so you haven't had that tailwind, but you have had still good sort of that precious metal haven effect. You do see that, particularly silver has kept up with gold. But I think really then you start to differentiate based on their industrial uses. So silver's been very strong, largely because we've also had good fundamentals. So we've had mine supply struggling. We've had very strong solar installations globally. That has all tightened silver, drawn down inventories. Whereas platinum and palladium have lagged. And that's been, as we've seen this, switching in electric vehicles using less PGM catalysts. So I think we should also be mindful of their separate fundamental stories. But so far, silver is very much keeping up with gold.
Let's talk about another metal, if we can, and go to the copper story. Guy and I were talking about whether or not copper is responding more towards the fiscal kind of impulse in China, or perhaps more to the tariff threat out of the U.S. Where do you stand on that?
I think that the big story for copper really has been around tariffs in the US this year. So copper, I think, has exceeded many people's expectations. Year to date, COMEX up around 30%, and the LME benchmark up around 11-12% as well. And I think that's really been the expectation of tariffs, and arguably that changes once tariffs are actually introduced. So the expectation of tariffs has created a big incentive to ship metal to the US. This has tightened markets outside of the US. We've seen inventories drawing down, and we've seen premiums tightening. And then as tariffs are actually introduced, that incentive to ship that metal goes away. And we heard on Wednesday last week, these tariffs could be in place within weeks, not months, with the Section 232 investigation ongoing. So at this point, it gets quite risky to put metal onto a ship and send it to the US in case it doesn't arrive on time.
Amy Gower, head of metals and minings of Commodities, we thank you so much.
OK, let's take you to Paris. I want to take you inside the court building. Marine Le Pen is arriving for the culmination of the case that has been brought against her. This is a pivotal moment in French politics. We will see that result shortly, we think. As it happens, we will bring it to you. But Marine Le Pen is now in the building, and we are counting down to what we are going to get out of that French court.
At stake, the future of French politics in 2027. Is there a backup plan? May not be. We're going to bring you the latest, as Guy said. Coming up on the program, a new base for EasyJet opens today at Southend Airport. We're going to be speaking with the CEO, Kenton Jarvis, coming up next. This is Bloomberg. Welcome back to the opening trade. About 44 minutes into today's session, and we are seeing red across the screen. There is nervousness in the market in risk assets, from stocks to bonds, even to the currency picture. We'll throw in a little bit of commodities in there as well. People are worried, and you can see it reflected in today's trade.
The weather outside, as Kristen put it a little bit earlier on, is lovely, though. So that should be maybe the jumping off point for our next conversation. I want to take you to sunny Southend. EasyJet opening a new base there today at Southend Airport, this ahead of the busy summer travel season. How busy will it be? It, of course, comes as we see rising global uncertainty over tariffs. Is that going to have an impact on consumer confidence? What is happening with consumer confidence, both here in the UK and across Europe? Well, if you want to know what's happening in the global economy, or in the European economy, I would say ask an airline CEO. So let's do that right now. The CEO of EasyJet is Kenton Jarvis, and he joins us from Southend. Kenton, congratulations. Thank you very much indeed for joining us from sunny Southend. Look, you're opening a new base, one of many here in the UK. Should I take this as a sign that you believe that consumer confidence is fairly good right now?
Thanks, Guy. Yes, we're here in sunny Southend. It's a beautiful day here. And this will be our 10th base that we're opening here in Southend. We're going to base 3 aircraft here, and we're seeing good things for the UK. We continue to invest. Last year, we opened a base in Birmingham, added 3 aircraft last year, and we're adding another 2 this year. And we continue to add aircraft into the UK. We've got another one going to Bristol, one into Liverpool, Manchester, and Edinburgh. But yeah, very happy to be here in Southend.
So you still see positive things for the UK, for the aviation market in the UK. Others in your industry, and I'm of course talking about your oppo over at Ryanair, maybe pouring a little bit of cold water. You paint a more positive picture, Kenton. Is that the right way of reading it?
Yeah, I mean, we're seeing the bookings for this summer. And they're looking good. Bookings are ahead at this time. And we've obviously seen good growth continue for EasyJet holidays. We advised the market that would grow by about 25% this year, and it's certainly keeping up with that.
In terms of what is holding you back right now, what is it? Is it the availability of aircraft? Is it the availability of slots to operate from? You're operating out of Southend. Would you rather be operating more out of Gatwick or other hubs that you've got across Europe? What are the limiting factors? What are the constraints on EasyJet's growth at the moment?
Well, I mean, obviously both the OEMs, Airbus and Boeing, are struggling with production. We were slated to get 9 aircraft this year. We've had 8 of them. The 9th one is going to arrive in advance of the summer, so we're fortunate from that perspective. In terms of slots, great to be able to open an airport here in Southend, but we see other opportunities. Tomorrow we're opening a base in Rome for Micino. And then on Wednesday, I'm actually opening the base in Linate, which is a great opportunity to fly from the centre of Milan. So we continue to look for opportunities and are growing where we see them.
Kenton, it's Kriti in London. Speaking of those opportunities, let's talk about your view on Heathrow. I know you've previously said that you could be interested in a potential increase in capacity with a 3rd runway in tow when it does openly open up. Other airlines have talked about fees and a regulatory structure being major issues. Is that a concern you share?
Well, I mean, it's a bit early for us to be talking about Heathrow. The 3rd runway would obviously give that potential. Right now, Heathrow is a very constrained airport, and we would only be able to get a couple of aircraft in there, which just isn't worth it with the marketing cost to let everyone know that we're in Heathrow for 2 aircraft. Clearly, if a 3rd runway's built, then that would open up a lot more capacity and enable us to base there at a scale that would make us relevant. And that would be a great opportunity for us because obviously it's mainly flag carriers in Heathrow, and it'd be a good opportunity to bring in an airline providing affordable fares.
Kenton, what was the lesson for you, or perhaps your takeaway from the recent power disruption at Heathrow?
The lesson is more for the airports we do operate from, and I've obviously spoken to Gatwick and others to check on their resilience measures, but I'm not close to Heathrow because we don't operate from Heathrow, so I'll have no more information than you would.
Kenton, let's talk a little bit about what is happening with sustainable aviation fuel. I was down in Toulouse last week at an Airbus event. SAF was a big subject there. Obviously, we've started to see blend mandates coming into Europe this year. The question now is, and this was the question that was raised at A4E last week as well, is whether or not actually we need to pare some of those back. The availability of SAF is now becoming a problem. It is very, very expensive and looks like it's probably not going to come down in price anytime soon. Do you think it's time for Europe, for the UK, for others with blend mandates to reconsider maybe some of those targets?
I mean, at the moment, we're required to blend 2% SAF along with our aviation fuel, and there is enough supply for that. We're finding enough supply for that. The mandate ultimately is on the fuel majors, and as airlines, we'll only be able to buy what's available in the market. So the kind of advice would really be for governments and the fuel majors to look for the solutions to ramp up the supply of SAF, because unless they do that, then it will obviously be a challenge to meet those mandates.
But at the moment, the issue is that it is expensive. And if you continue to push those mandates forward, it does look as if airfares are going to have to go higher. Is that just something that is inevitable now? Guillaume Faury was telling me this last week. It is inevitable that flying is going to become more expensive if we continue down the track that we're on at the moment. You are a relative low-cost operator compared with some of the obviously the big players in terms of the long-distance players, I should say. Do you think flying is going to become more expensive if we continue on the current track that we're on?
I mean, at the moment, SAF is 3 to 4 times more expensive than jet aviation fuel. But in part, that's because there's very limited supply of SAF. And I think that's why it's upon governments and fuel majors to find the mechanisms that will promote much more of a scale up in the manufacture and supply of SAF. And then I think if there's a healthy supply, then the market should be able to correct the price. But right now, if it remains 3 to 4 times more expensive and the mandates come in, and there is enough SAF to buy, but it's at that cost, then that will unfortunately make travel and flying more expensive.
Kenton, you're relatively new to the job. I think that's probably a fair way of putting it. Obviously, you've got a long history at EasyJet, but you've now taken over as CEO. Is this a continuation? Are you continuing with the strategy that obviously the company has operated under? Are you getting any surprise? How's the first year going, I guess is the real question that I'm asking. How's it going?
Thanks a lot, Guy. Yeah, I'm really enjoying it. Thanks for asking. Not quite 100 days in, and I've used that time to get out and around in the network. I mean, one thing that is really I'm convinced of is that our people are the differentiator here at EasyJet. That kind of warm welcome in the sky, the warm welcome now on the ground, and the engineers that we have, along with the crew and the pilots, really make the difference. And it's been a real pleasure getting out to see them all. As you say, I've been at EasyJet a number of years. I was a CFO before, so I helped co-create the strategy that we're following. Still think it's the right strategy. Last summer we had our record summer that culminated in the second best financial performance for this airline in its history. We see EasyJet holidays continue to grow. We expect it to grow another 25% this year. We continue to look for opportunities to expand the network. So I just want to build on the success that we had last year and see where that can take us.
Great to see you, Kenton. Thank you very much indeed for joining us from sunny Southend. Why would you need to go anywhere else is my question on a sunny day in Southend. Kenton Jarvis, the EasyJet CEO, thank you very much indeed. Let's talk about what we got coming for the rest of the week.
We are...
Apart from our travel plans.
I was about to say, I kind of want to go to Southend. That seemed very, very nice. We've got a roller coaster in terms of the week ahead. Plenty of data on both sides of the Atlantic, from CPI to manufacturing data, all really counting down to payrolls on Friday. And somewhere in there, we get some tariff content as well. So what moves the markets more? Luckily, I don't have to answer that question, but Valerie Keitel does.
No pressure.
Yeah, no pressure. I mean, what walk us through it. What's on your radar? How does this show up?
Yeah, well, to me, it seems that the payroll print on Friday just seems light years away at this point. We have to get through Trump's tariff announcement to come on Wednesday when it comes to those reciprocal tariffs. But I want to talk a little bit about the recent correlation that we've seen in the stock and bond market. We have the first quarter in 5 years where we've seen a negativity in the stock market cause a rally in Treasuries. We've not actually seen that since March 2020. And with everybody talking about a recession, kind of opens the door up to talking about, do we think whether this traditional correlation will continue? Because if we do head into a recession, Guy, we are heading into a recession with a deficit already 6 to 7% of GDP. And deficits tend to balloon, maybe even double when you head into a recession. So do you really want to be buying treasuries into a recession if the deficit reaches 13%?
Because there's automatic stabilizers. Now, the US doesn't have the same level of automatic stabilizers that you have here in Europe in terms of the social welfare bill. How big could it get? What could issuance look like in that kind of environment?
I mean, it could look huge, right? If we look
and where would it be?
If we look traditionally, the deficit climbs nearly 5 to 6% of GDP during a recession. So that's a 13% GDP of a deficit. And I guess traditionally, if you think that we're headed into a recession, you just close your eyes and buy the 5-year note. But this time around could be different.
The Fed would be cutting aggressively, presumably.
Well, let's hope so, right? Let's hope so that they instead, what Powell told us in his press conference is that they are willing to almost look through a bit of tick up in inflation to protect the labor market. We do get labor market data on Friday with payrolls, right? I think the market might in some way want a weak number because in some way we want to know that the Fed put is still there, even though inflation expectations are rising. I think something that could help the equity market in a perverse way.
Give us something, Jay Powell, just literally anything. But it brings us back to the point of how does the Fed even view tariffs, because it wasn't the expectation that Jay Powell would put some sort of March 2019, some sort of insurance cut in the works if growth was still the focus. And yet we're still talking about inflation being the focus. Is there a credibility of the Fed question here?
Look, in some ways, yes, right? I mean, if he declares that the rise in inflation due to tariffs is transitory and cuts into that, obviously it could prove not to be the case. But if we look at all the analysis that the Fed has done, is that this will impact growth in a more negative way, and they are more worried about the labor market. But they have to, in order to do those insurance cuts that you talked about, Kriti, they need to see either a tick up in the insurance of the unemployment rate or some weakness in the labor market. So that's what they're looking out for. And in some way, maybe that'll be a good thing if we get weakness in the labor market, right? Because then we have Powell saying that he's ready to cut.
Val's definitely looking for the glass half full trade.
Spoken like a true market gal.
That just about wraps things up. We've got a busy week coming up. There's an event coming up very shortly, though, you want to pay attention to, and that is happening in Paris. Let me just quickly show you a live shot from Paris. This is the outside of the court. We're inside the building, but outside the court. We're about to get the ruling on Marine Le Pen's political future. That is coming up very shortly. The Pulse will handle that for you. We will bring you that as soon as we get it. Key moment for France coming up. That wraps up this show. The Pulse is next. This is Bloomberg.